Hi, friends. Thank you so much for joining us for our webinar on premium tax strategies. So this is for anybody who owns income-generating real estate. That could be commercial property, things like hotels and self-storage or industrial, multifamily. Could be residential rentals, so investment properties, even down to single-family properties that cost $150,000 to $200,000. All of these are potential opportunities for increasing how much you can get in tax savings up front so that you can reinvest that. And ultimately, the name of the game here is giving you access to your tax savings now so you can reinvest it and continue to grow your portfolio and your wealth. So my name is Daniel Boyd, or Dan Boyd to be a little more familiar, and I am one of the vice presidents at CSSI. I work with our external sales team and some of our larger accounts. And I love the opportunity to get in front of people and share about cost segregation and 179D and all things accelerated depreciation. So a little bit about who we are and what we do. So CSSI is the leader, the nation's premier engineer-based consulting firm. So we specialize in the tax laws surrounding commercial buildings. And we've been doing this type of work for over 22 years with 45,000 plus studies in every state and some internationally. So I mentioned a couple of the things that we already offer. So cost segregation and disposition studies, capital to expense reversals, 179D energy efficiency studies, R&D tax credit analyses, and a really unique product called Green Zip Tape that allows you to accelerate even more on commercial properties by turning things like drywall and the interior components of walls into accelerated depreciation. So a quick overview of our presentation today. We're going to talk about cost segregation, depreciation in general, and then 179D. So when you leave here, you should have a better understanding of these three topics so that as you go forward, whether it's in a conversation with your tax professional or it's in looking at investment property, you have a better idea of how to mitigate your tax burden and convert some of your investments into tax savings so that you have more capital free to invest and make a return on. So let's first talk about cost segregation. So what is this? It's kind of a funny term. Most people hear segregation, they're like, oh, that sounds like a bad thing. Well, think separation or division. And really, at the end of the day, for you as a building owner or potential building owner, cost segregation means cash flow. So here's some formal terminology here. So this is the process of analyzing and identifying commercial building components that are eligible for accelerated depreciation. That means you get the deduction sooner rather than later. So this results in lower income taxes, meaning what you owe. So you will owe less if you use cost segregation. And this is part of the US tax code. This allows building owners to use your cash today rather than sending it to the IRS. So rather than leaving tax savings in a commercial property tied up in long-term depreciation, you get it now so you can take advantage of the time value of money. So some of you might be working in residential rental property, so that has a tax life of 27 and a half years. But for other commercial property, that tax life is 39 years. And that means you have to wait 39 years to get the full tax deduction for your property, which is a long time for most people. So what we do is we allow personal property to be separated or segregated from real property, that is real estate. And in general, we have found that we can help increase cash flow by 30 to 80,000 per $1 million in building costs. So if you buy a piece of raw land and you spend $1 million to develop that land, we think that we will increase your cash flow as a business owner by somewhere between $30,000 and $80,000. And this works not just on buildings, but on tenant improvements as well. So if a tenant pays to build out a space that they're leasing, they can use this. Or if a landlord pays for the tenant improvements, renovations, any building improvement is a good candidate to look at for cost segregation. So first, what is depreciation and how do buildings depreciate? And most people hear depreciation, they think of a car, right? They drive it off the lot and it immediately depreciates and the value goes down. That is a type of depreciation, which is a loss of value, but this is a different idea. So depreciation, when talking about taxes, this is a tax deduction, recognizing that buildings lose their, you could say, their useful life over time. And so if you own a building every year, you are going to take a depreciation expense, and that's either going to be 1/39th the building value or 1/27th the building value, which is, I would say, a slow way of depreciating this. And most people, when they think about things in their building, they say, well, there's not a lot in my building that's going to last for 39 years or even 27 and a half years. Can't I get the benefit of that sooner? And the answer is yes, you need cost segregation to do it. And so here's how it works. So we like this bucket analogy. So if you look on the far left, you'll see that there's a 39 or 27 and a half year bucket. So imagine you buy or build a property. All of your expenditures go into that bucket, and you have to depreciate your property. That means write it off for tax purposes over either 39 years or 27 and a half. And so just by default, everything in your property is in that category, and you can't take advantage of it any sooner. However, if you do a cost segregation, work with a company that separates out the components of your building, now we break that one bucket into multiple buckets. And so we can take some of the value of your property and put it into a much shorter recovery period. So 5 and 7 years for what's called tangible personal property, 15 years for what's called QIP, real property, and then 15-year land improvements. And so if you think of it this way, if I give you $15,000 that you can take over 15 years, well, that's pretty easy to recognize. You're going to get that money a lot faster than if you have to divide that over 39 years. So this, in its kind of in a nutshell, is cost segregation. We change how quickly you're able to get the tax deductions out of your property. And you're going to get some of those over 5 years, some over 7, and some over 15. Now, the good news is there's a way to make it even faster. So in 2017, at the end of September, there was something introduced called the Tax Cuts and Jobs Act, and that allowed property owners to bonus depreciate those buckets. So what that means is rather than waiting 5 years to take all the 5-year category or 15 years to take the 15 category, you could bonus depreciate or rapidly depreciate a large percentage of that. And that means that you're not going to wait 5 years to get that value. You get all of it right now. You're not going to wait 15 years to get that value. You're going to get all of it right now. And so for a period of about 5 years, we had that law in place. So if you put a building in service in between the end of 2017 and the end of 2022, your property was eligible for 100% bonus. Starting in 2023, that number started to sunset, meaning it goes down a little bit every year for 5 years. So if you put a building into service in 2023, it's eligible for 80% bonus. If you put it in service in 2024, then you got 60. This year you get 40, next year will be 20, and then after that it will be 0, which means that you don't get to take any of the 5-year property or the 15-year property in a bonus way. You just take it the normal accelerated way, which is still significantly faster than taking it over 39 years. Now, President Trump has since said that he is going to bring back 100% bonus, and if he does, it will start from the inauguration date. And so for those of you who purchased real estate and placed it in service in late January and beyond, you hopefully will be eligible for 100% bonus, and we'll keep you updated on that law as we move along. So we'll say just fingers crossed that anybody who acquired real estate this year is going to get a better opportunity there. So let's look at an example of this. So this is an $8 million hotel, and with a cost segregation study, we were able to identify significant tax savings. So a standard deduction for this person would be significantly less. So that 26,000, that's probably actually a little low, but they wouldn't be deducting a lot. It might be that much, but with accelerated depreciation in the first year, this person is able to bonus depreciate. You'll see there $700,000. And so that is absolutely outstanding that in the first year of operating this hotel, the ownership is able to get a deduction of $700,000. And so maximally, that could be a $259,000 tax savings. And that's money that you can immediately put back into your business. You can pay down debt. You can maybe buy another building. There's many, many things you can do with 259,000 that if you send to the IRS, you'll never see again. But if you keep it in your own property, that's the gift that keeps on giving. So what does this involve, right? How do you make a cost segregation happen? And so what we do is we create an estimate for you and go over it to say, here's the ROI, here's the cost, here's the potential savings that a cost segregation would generate for you. And then we would do a site visit. So a photographer comes out and takes pictures of the property, which is required by the IRS. We review any available documentation that you have, and then our engineers go to work and they will create the building analysis and breakdown or the actual segregation and author a report. And that report is what allows your CPA or tax professional to increase your deduction. And so that report, if you ever got audited, is what the IRS would look for to say, okay, help me understand why you depreciated your building this way. And we're very proud of the fact that our results have never been rejected by the IRS. So just a handful of cases, the IRS has asked for a little additional information on how a client got their numbers for cost segregation. And when we've explained our methods, the IRS has been satisfied with it. So we're very keen to keep that track record, which means that you can rest easy at night knowing that your results are going to be safe and they're not going to get you in trouble. So that time period usually takes about 2 to 4 weeks. And so we can turn this around very quickly. We can do a lot of properties at once. Luckily, we have a very well-seasoned and experienced staff, and we know how to do this. We know that often you're under a deadline. And so we'd love to be your partner in those scenarios where your CPA needs the answers very quickly. We can get this back and make sure that you're able to file on time and that you're able to get the maximum deduction available to you. So some common concerns that we hear are things like, well, doesn't my CPA do this already? Or will this trigger an audit? And unless you are working with a very large CPA firm, they are not going to do this because cost segregation has to be done by an engineer. It's actually a type of the engineering discipline where they look at a property and they break down all of the components to determine the cost. And that's not something a CPA has the expertise to do. And so when CPAs provide a client with a cost segregation study, they're very often coming to a firm like ours and asking us to complete the study for them so that they can present it to their client. Now, will this trigger an audit? And our experience is that no, it does not. So in over 45,000 studies, we do not believe that a cost segregation has ever triggered an audit. We have had clients get audited about 24 times in 22 years, so a very low audit rate. And in those scenarios, the IRS has not had a problem with our results. Now, the other reason you might want to just pause on this is if you're going to sell the property quickly. The reason for that is when you take depreciation out, it allows you to owe fewer taxes. But when you sell your property, the IRS recaptures that depreciation. So it essentially means that you're getting taxed on the amount of depreciation you take out. So this isn't a bad thing, right? You're essentially getting an advance on the sale of the property. You're getting some of that cash out now so that you can reinvest it rather than waiting until you sell the property. And so, yes, you will have to pay recapture, but as business owners and operators, you know how to put your money to good use and to make a return on it. And so you may be subject to recapture, but that just means that you're getting almost this interest-free loan from the IRS to invest. When you sell the property, you're going to give the loan amount back, but anything you make your rate of return, that's yours to keep and continue to reinvest in your properties. So we'll rather than answering questions now, I'll wait on some of these until later. But here's some common things that we like to clarify with people. For instance, how does depreciation work? What exactly is additional to cost segregation, or what does it mean? How does acceleration work, and how does bonus work? And so I'd say, especially if you're watching a recording of this, you can just go back to those parts of the video and watch it there. And then if we have questions later, we'll come back to these things. So the next thing I'd like to talk about is Section 179D, and this is an additional tax savings opportunity. And again, like cost segregation, this means cash flow. This accelerates how quickly you can get the cash out of your building so that you can reinvest it. So 179D is a deduction based on the energy standards of your property. This is any property built after 2006. And so it applies to three building systems: your interior lighting, your building envelopes, I think doors, windows, and the seal, and then the HVAC, so heating, cooling, ventilation, and hot water systems. So to qualify for the maximum incentive, new construction or renovation projects must reduce a building's energy costs by 50% or more compared to a baseline reference building based on the 2001 or later energy efficiency and technology standards. In other words, kind of simple English, if your building is more efficient than is required, then you are entitled to a deduction based on the efficiency of your building. What's great about this is a type of depreciation that a cost segregation can't touch. So interior lighting, building envelope, heating, ventilation, cooling, and hot water, these are considered part of that 39-year or 27 and a half year structural components of the property. And ordinarily, you have to depreciate these slowly. 179D allows you to more rapidly depreciate these components. And again, so you can get your money out of the building now and get the tax savings that you want so you can reinvest in your property. So this tax incentive can be claimed by a building owner, tenant, or energy services corporation, depending on who's pays for and owns the energy efficient commercial property. For government-owned buildings, the incentive can be claimed by an architect, an engineer, or a contractor, maybe an environmental consultant, sales engineer, energy services provider responsible for the design of the energy efficient system. And so this is both eligible for commercial property owners and for nonprofits or government-owned buildings. The deduction is a sliding scale. So for older properties before 2023, that's placed in service before 2023, the owner can expense somewhere between 60 cents and $1.80 per square foot on the qualifying system. So we talked about lighting and envelope and HVAC, and this provides an immediate tax benefit to building owners who would otherwise deduct those costs over 39 years. So again, rather than waiting 39 years to get the tax benefit, you're able to get it much faster. So in 2023, this deduction increased to up to $5.65 a square foot. So if your building was built or renovated between 2006 and 2022 or 23, then let's say on a 100,000 square foot building, you could get in between $60,000 and $180,000 of a deduction in year one. And then for buildings placed in service after 2023, that deduction can go up to $5.65, which would mean on that same building, you could get a deduction of $565,000. So this works for all commercial buildings, parking garages. It can be privately or government owned or for profit or government owned. And then for multifamily buildings, it's got to be greater than 3 stories. So 4 stories and up qualifies. And what does this look like, right? How do we do this? So similar to a cost segregation study, we would first create an estimate. We'd look at some of the energy systems in the building. We usually start at buildings that are about 40,000 square feet and above. And then after we do that feasibility study, if you choose to engage, then a professional engineer would visit the property and they would model the systems for the IRS to meet their standards. And then that would give you the report that you would use to deduct this additional savings. And to qualify for that full deduction, I'll go back for a second. So how do you get the $5.65? So in addition to having your heating, ventilation, lighting, your building envelope, and your, I guess any other of those, like the building envelope, the HVAC, and the lighting, each of those has a sliding scale. And then if you use what's called prevailing wages and apprenticeship, so if you use union labor, then you qualify for that full $5.65 deduction. If you didn't use prevailing wages and apprenticeship, then you can still get a substantial deduction after that as well. So that is all on 179D, on depreciation, on cost segregation. Thank you for joining us and thank you for staying with us for this video. So if you have any questions, you can get in touch with me. There's my direct number there, 407-451-8996. And again, my email address, which is danielboyd@cssiservices.com. And if you are curious, hey, how much money is available to me? How much can I save this year? Just get in touch. We create our estimates for free so that you can know uh, just what your expected ROI is going to be. So there's no surprises. When we're doing a cost segregation, we always see some kind of savings, and the ROI makes sense. If it doesn't make sense, we will let you know. We'll just say, hey, you know what, not on this one, but another one. And I would say 99 times out of 100, the ROI is a no-brainer. And people see it and they say, you know, why wouldn't I do that? Because otherwise, I'm going to send this money to the IRS and I'll never get it back. So thanks so much. Good luck to all of you and look forward to hearing from you soon. Thank you. Bye.